Good morning. Good morning, everybody. Thanks for joining the ARMR Report. I'm Brett Rosenthal. This is a show about stock market investing, as you all probably already know. A couple ground rules real quick. I am changing the format of today's show a bit, and what I want to do is really focus on actionable information by taking you through really a progression of chart patterns leading to thoughts of what should be at the top of somebody's whiteboard when it comes to investments we may make going forward next week. So that's the focus of the show. I'm going to share some thoughts with you, big picture on what's going on in the market, then dive right into these chart patterns. So grab a pen, grab a piece of paper. You might want to jot some things down to help order your thinking for next week's trading activity. As always, this is a show centered around the ARMR investing way, which is something I've been developing over 30 years of running money. Okay. So basic three-stage process. We try to get rid of all the noise out there and just focus on how to protect capital and capture upside when appropriate. We do it by this three-stage approach. We build our whiteboard. We're going to talk a lot today about what's on the top of the whiteboard for possible investment. Then we use algorithms, both big picture algorithms about the indexes, and then drill down into algorithms for single stocks, okay, to help us execute. And then we use stop losses to protect ourselves, basically from ourselves, right? Get rid of emotion, get rid of inertia, execute, and then let the probabilities and the hard work of your research process play out and increase net worth. So, as always, this is not investment advice, right? This is how I run my own personal capital. You have to make your own decisions. Please consider your risk tolerance. Consider what your goals are. You've got to do that on your own to figure out how to build and structure your portfolio, okay? Some of you are more aggressive, some more conservative, right? Some ideas center on dividend plays, and that might appeal to a more conservative audience, right? The rest of you might love crypto. So you all have to determine how to build your own portfolio. These thoughts I'm going to share are how I order my own thinking. And I do it every Saturday. You know, I'm glad if it helps you, but at the end of the day, you guys really help me because it helps me focus my thoughts to a fine point. So I'm ready to take on the week going forward. So here we go. Let me, of course, if you want to subscribe, you can always subscribe right down here to the ARMR Report. You can subscribe to this YouTube channel. Don't forget, hit the like button and all those other things to help out me. But also, if you'd like to be part of the ARMR Insider crew, you might want to subscribe to the ARMR Report, right? We run a Slack room all day sharing investment ideas. All right. And I like to say we're an army of analysts backed up by a tank division of algorithms, and that's how we capture alpha. So consider joining us. All right. Let me dive right into a couple thoughts about a big picture market. You guys know the ARMR algorithms. We have 8 of them designed for the indexes. And so let's dive right in with charts. I want to really be chart centric on this show today and try to do that really every week with you. Spend a little more time looking at charts than looking at my, handsome face. All right, look, here it is, the S&P. So here's every little touch of the uptrend, every little touch of the 50-day moving average. And you can see the market breaking below the uptrend, below the moving average. But to such a small degree, you can't really call it a breakdown. So let me first say this. I know there's been a lot of talk about gamma information, options flows, vanna flows, okay? And this chart that you're looking at, everybody and his brother and his little sister and the dog are now talking about how the market always goes up after OPEX, okay? So almost every one of these sell-offs occurs right around options expiration, and then the market grinds higher. That is a function of the way the Greeks express themselves after every going into and then after every expiration. Okay. It is so well known now that, of course, usually when everybody knows it and it's been written on the cover of Time magazine or whatever, the New York Times, it generally begins to lose its value, right? Information is most valuable when fewer people know it. When everybody knows it, what eventually starts happening is one of two things. One, it gets front run. So people start doing it before it actually happens. And then what happens afterwards doesn't respond the way you think because there's already been that action. So it starts to move the needle of when the gamma information matters. And two, there is a complacency that gets built into the market. There's this expectation that it always works. And when it doesn't, it's such a shock that the sell-off can be fairly aggressive. So I want to share with you this morning, I get it, okay? This is the typical sell-off. And what's been happening all year to the ARMR algorithms is that each one of these sell-offs drives us into risk monitor red. Every one of these drives us to risk monitor red, only to have it reverse the very following Monday, and we end up chasing the market a bit. Some years are like that. It's incredibly frustrating. Look, I'm the first to tell you, my performance this year is mediocre at best. Okay? Not every year will I have explosive growth in my net worth. What I'm trying to do is protect capital first, capture upside second. Last year, explosive growth blew away the averages, right? That was because, quite simply, risk monitor red protected us from a market collapse. Risk monitor green got us in at the bottom, right? Which is what the algos are designed for, protect us from collapse. So in a year like this, where you get a bunch of these moves that result in immediate grinds higher, I'm spending more time protecting capital and not capturing all of that upside, okay? So full disclosure, happy to tell you, like I come on here and tell you how great things are going when they're going great. And I'm honest with you, when it's a year that is counter to the person who's trying to protect capital. This has been a year where you don't need to protect capital. The last 6 months, no need to protect capital. Market just keeps grinding higher. So here we are going into Fed week. I know there's all this talk about how we should see the market after the Fed meeting rally to new highs. It's possible it happens, but I'm going to walk you through a series of charts here. Because our job, we know that the expectation is the market will grind higher after the Fed meeting. Because there'll be natural Greek flows that should push the market higher. And because the fear of the Fed meeting is past us. Okay, but I have a couple thoughts for you about that issue. First of all, as of today, so risk monitor red for us was back here. And the market has traded lower since we went risk monitor red. Okay, so for a week now, the market closed on the lows. And so from our risk monitor red signal, so far for a week, that's been accurate, right? Because the market's now trading lower than it was a week ago when we went risk monitor red. This week, I always like to see what the Investors Business Daily is doing. William O'Neill is the cornerstone of really everything that I do. It starts with the kernel of the William O'Neill style of investing. And then out of that, we added our components to make it the ARMR Report, algorithms and things like that. But I still value what the IBD has to say when it comes to their risk monitor, right? And so today it turned yellow. So they went from very bullish all last week, even as the market kept making new lows. And finally today they say, well, maybe we're not so bullish. Time to be a little more defensive, okay? So that's kind of syncing up more with the ARMR algorithms, which were risk off a week ago. Let's run through charts for a second. So that's where it all begins and ends for me. If the market holds these lows, reverses, goes back up next week, breaks the downtrend, we'll probably be risk monitor green again. We'll put some money to work. But for right now, it's red. These are the indexes we follow. Okay, here's the value index, living below the 50-day moving average. Here's the Dow. Okay, living below the 50-day moving average. The reason I say living below is that during this whole market rally, the market has not lived below the 50. It'll break below, reverse, and go right back above almost immediately. But now we have 1, 2, 3, 4, 5, 6 days in a row where the Dow is living below the 50. Okay, so we're looking for subtle changes in market behavior. And if you pay attention, you can see it unfolding. Now, here's a positive, okay? Small caps are looking a little bit better, all right? They're below the 50. And again, it's been below the 1, 2, 3, 4, 5, 6 days, but kind of real tight to the 50. So I wouldn't really call that below yet. And it actually closed higher, right? The big indexes were closing at new lows for the week, and the small caps were closing higher. So that's something to give us pause. I'm not exactly sure about that. Okay, let's take a look at, and then of course we can look at the Qs real quick. So the Qs are the strongest index, even though they close on the lows also. So here's the weird thing that happened last week. The biggest indexes closed on the lows. The smaller indexes were stronger. So we don't really get any direction what's going on there. And that almost suggests it really is gamma information, right? Because the big indexes have the most amount of gamma driving it down, and the little indexes don't have that same thing, right? So let me show you what I mean. First of all, here's the IBD 50. That looks phenomenal. There's nothing wrong with the market when the leading stocks are blowing out. And we're going to get to this when we start going through charts of stocks that are at the top of our whiteboard to be added to our portfolio if we get the all clear sign. We're going to do that in a minute. That's when you're going to want your pen and piece of paper, okay? So when you see the IBD 50 looking like this, and then look at what happened to the ARK funds on Friday. All of them, this is the ARKK, innovators, right? Stopped right at the 200-day, put it in a nice little bottom perhaps right there. I'm not exactly sure what's going on there. I know that Teladoc is a big part of that portfolio, and it had a good day. So that could be part of it. I don't know exactly how to read that. But at the end of the day, if we look at momentum, just to round out the stocks that we're looking at, the indexes, okay? Momentum has not broken down yet. So we have a setup for a normal rally after OPEX. The big indexes are weaker. The secondary indexes are stronger. So that would tell us, hey, we get past the Fed meeting, probably markets go to new highs, probably. Now let's look at what would change that picture. Okay, I'm going to take you through a progression of stocks, and I want you to tell me what you think it means. Okay, treasuries, long bonds, interest rates. So when this asset goes down, interest rates are going up. This is the long bond, the most sensitive asset to interest rates. Okay, talked about it last week. It was breaking out at the start of the week, and it had a reversal week closing on the lows. Okay, so it closed on the lows of the week, reversing the breakout. If this takes out the uptrend on the downside and goes back below the 200-day moving average, it's going to tell us the market believes, and the bond market particularly, which tends to lead the stock market, that the bond market is believing rates are going up. We're going to discuss why in a minute. Let's take a look at this indexes, okay? So then we look at XLU. You know I like this group, but look at what happened on Friday, okay? The breakout that was trying to unfold in utilities is imploding right now. Closes below the 50-day moving average. Okay? We've reduced our exposure to the utility index. We've reduced it. Not 100% out, but we've reduced it. Now take a look at UUP. What is going on with the US dollar? So I've drawn, this is a Fibonacci fan for those of you who use Fibonacci sequencing. If you don't, I strongly recommend you do some reading and research on it so you understand the importance of Fibonacci. It works to a ridiculous degree. It's like one of those weird facts of life that humans follow a particular progression. And nature follows a progression. It's bizarre, but it works. That's delicious coffee. All right. So what this tells you is Fibonacci fan, when it breaks the third downtrend, it tells you that the trend is changing, right? So it breaks the first downtrend, no big deal. Breaks the second, maybe. When it breaks the third, the trend is changing. So the trend in the dollar has been to flatten out, no longer declining. Now it's flattening out. And as of Friday, it's starting to break out. They tried to put the dollar down a couple weeks ago, and it immediately recovered and is breaking out. So treasuries, utilities, dollar, and now gold. Total breakdown implosion. Here's the downtrend line. Gold trying to get above it. Gold can't get above it. Gold gaps down. There would have to be a miraculous recovery. I mean, unbelievable median bar reversal recovery in GLD. And I'm just using GLD. Just don't get into debate about what asset's best. I'm just using this as a way to take a look at gold. Okay. There'd have to be an unbelievable recovery. I mean, like median bar reversal, type of island reversal, gap up, recovery to get me to even consider gold again right now. It's dead. It's totally dead. Look at silver. Okay. Couldn't be worse. So when you look at the progression of those charts, those price chart patterns, what is it telling you? Dollar up, interest rates up, utilities down. So dividend stocks may run into trouble, right? Precious metals getting crushed. Everybody's expecting taper talk, Fed to do something. Those chart patterns are telling you that big money is moving in a particular direction. I think everyone expects the Fed to say something about taper or whatever. And I feel like everybody's very sanguine about it. Like, okay, the Fed's going to taper. Fed's going to reduce liquidity. No big deal. Gamma flows, vanna flows, going to save the market. Market will go up. I'm not in that camp, okay? I'm in the camp. It's very simple. Fed adds liquidity, market goes up. Fed reduces liquidity, market goes down. Big institutions know that. Big institutions will front run that simple equation. If the Fed talks about taper, but keeps adding liquidity, which it's been doing, then we don't have to worry. The market will keep going up. And the Greeks will help that. If the Fed actually, I don't even think the Fed has to reduce liquidity. If the Fed just doesn't add at the degree it's been adding, the market goes lower. That's simple. I mean, turn off CNBC. Forget about all the other ridiculous news. Look, in all due respect to some very smart people, I don't think stock buybacks can put the market up. I don't care how big the stock buybacks are. If the Fed literally stops adding liquidity, the stock buybacks just fill in the gap of what the Fed's creating. And at best, the market stays at these levels. But typically, big money anticipates what's happening and gets in front of it. So I feel there's this unbelievable complacency in the market. Risk monitor's red here at the ARMR Report. I won't argue with it. If it goes green, I'll put money to work. But at the moment of this conversation with you, risk monitor's been red for a week and the market's gone to new lows. Those charts, those 5 charts, show you that there's a shift in psychology towards higher interest rates, stronger dollar. Actual Fed reducing liquidity is what's causing that. Okay? So I think the risk of Fed week is that the news, not talking about the news, the reaction to the news is all I care about, is going to be more negative than people think. People are so conditioned. And this is the big, I mean, I've heard this so much that it's starting to make me nervous, okay? Everybody is telling us that when we get past the Fed meeting, large put positions will be sold, which creates vanna flow, which drives the market higher because we'll be past the big Fed meeting. Okay, I'll believe it if I see it. But I think the risk is that that inevitability doesn't occur. And so as managers of our own capital, we have to protect our capital, which forces us to take a position and act before the events unfold. This is what the algorithms are for. It's to protect us. So if the events unfold negative, we're already protected. And if they don't, then we adjust. And that's how I'm going into Fed week. Okay, so let's jump to, those are my thoughts on Fed week. All right, we'll see what happens next week. Here's one thing I'll just share with you that I think maybe people aren't paying enough attention to. So part of the argument of vanna flows driving markets higher after the Fed meeting, for those of you who don't understand what that means, boil it down to this. When you get past a major event and there's no really bad news and so the markets don't crater, whoever owns puts sells those puts. The guy who buys the puts are market makers. They're not in the business of taking risk. So they buy a put and they buy the underlying assets to match it off, right? And so what happens is there's this almost like an artificial buyer, which is the option dealers, who are buying the indexes while they're buying in puts that people are dumping. And so it drives the index higher. Okay, that's what a charm vanna flow is in a nutshell. Okay, so there's this belief that the puts will be dumped after the Fed meeting if what the Fed says is kind of, expected. They say something that's totally expected. There'll be this relief that it's not worse and people will dump their puts. I'm just throwing this out there. What if what we hear over the coming days is a louder drumbeat that there is going to be a debt ceiling problem come September 30th? Now, I'm not saying that the government will shut down, blah, blah, blah. I don't know. But it's the fear of that, right? If people start to be concerned about that, do they not dump all their puts as fast as people believe? And if you're reading the stories I'm reading this weekend, it seems like there's going to be, at the very least, some high-profile fighting inside of government, as usual, okay, into September 30th, which are also month-end options, which have a big impact, okay? So my question to you is, how fast does the vanna charm come back? If you've got September 30th debt ceiling issues, which it seems like a fight is brewing, that will keep fear higher than people think. That's just a thought. You heard it here first if it turns out to be true. If not, please totally disregard everything I just said. All right, now let's get down to chart patterns. This is how I'm building my whiteboard. Whoops. Here's the whiteboard. If we acknowledge that the IBD 50 is leading the market, these are high quality growth stocks. I don't know about quality. I don't know how to say that. These are basically significant growth stocks are in the IBD 50. Huge quarterly earnings, annual earnings, accelerating growth. That's what this IBD 50 chart is telling you. Money is going into accelerated growth stocks. Hey, by the way, those are typically the stocks that lead at a time when interest rates are going up. Interesting, right? Until such time as the whole market implodes and then they get destroyed, okay? But at the beginning, people hide in high growth stocks when interest rates and inflation show up, okay? So I look at this chart. I look at, the ARC Innovator. I don't know if I'm not sure ARC Innovator is really going to help us as much. I like the IBD 50 better because it's not so tied to one person's opinion of a particular company or industry. It's an algorithm that puts stocks onto the IBD 50 list and takes it off based on an overall view of aggressive growth stocks. And that's why I use this, primarily as a source for my risk monitor. Okay. So anyway, what's at the top of my whiteboard? Grab your pen, grab a piece of paper. Oops. Grab your pen, grab a piece of paper. I wonder if you like it like that. Maybe you like to see it like that. You can talk to me at the same time you can look at a chart. I always feel like you want to see the chart as big as possible. Anyway, here we go. Here are the charts that would be at the top of my whiteboard. You guys ready? You got the pen, you got the piece of paper? Here we go. First thing I like to do when I get risk off everywhere and go to cash is follow the stocks that I've just sold to see how they behave. These, without a doubt, are at the top of the list. You would think with the market making new lows in the last week from the risk off signal that you would get Unity selling off. Instead, it's making another high tight pennant. PLTR, right? Instead of breaking down, we booked a profit on this. It broke out, Randy here, we booked the gains. Now the whole thing blew out last week, making new highs. All right. So I'd love to get back into this trade. Let's say the market goes lower for a couple days and drives this back down below its 28 gamma, somewhere in here, right back on top of this cup and handle base. Ooh, I'd be all over that again. All right. Airbnb. Really fascinating. This stock got downgraded right here by Goldman Sachs to a sell. Right here. Had one massive down day. Now the stock made a new high last week. These are stocks on my whiteboard. This is not investing advice. You have to go do your own research to make sure it's something that aligns with your risk tolerance and your goals. All right. So this is my list and I share it with you so that you have an idea of where to go and do your own homework. All right. These are some of the names at the top of the list. Let's keep going. Now there's some big cap names. Some of our best positions in the ARMR report. It's like Microsoft, all right, Amazon right now. Okay. But here are the names at the top of the board to add to these big cap tech companies. I think CRM's got to be focused. Oops. CRM. It deserves our attention. All right. Salesforce looks like it's really, it came out of that base right here on solid earnings on that gap up there, pulled right back to the 50. That's an ideal entry point. Okay. CRM, top of my list. Those of you who are interested in semiconductors, I don't usually own semis. I might trade them, but I don't always focus on them. But I do think there's an opportunity in AMD if it holds and makes a double bottom at the 50-day moving average. So one of the things I love to do is have a huge chart pattern like this break out, which it did on, it just ripped higher, right? So that's the breakout of the base. And then I like to see a double bottom set up at the 50-day moving average. And if it holds, and let's say it were to take out the high of this bar and we get an algorithmic buy signal right there, that would be a chance to own AMD. And by definition, that means you could also own Xilinx because they're both in the process of combining. And there's an extra kicker here. If the deal goes through, the stock goes higher because right now it's trading at a discount to the deal. So maybe you own both. That depends. All right. Also, AMAT. All right. Look at Applied Materials. That is a phenomenal tight chart pattern. And it's nice if you go over and look at the weekly patterns sometimes. You can see it even better. There's a clear pennant breaking out here. So you had this original breakout, which was enormous on Applied Materials. Now it's made a whole new base. And we know there's still a chip shortage. Right? And so here's a guy who makes the equipment for chips. That looks really good right there. I'm going to throw this out there because it's such a laggard, but one day I dream that Micron's eventually going to catch up to the crowd. When it does, it has a really nice run. So it's on the list. Here's the breakout of a pennant, rips higher, totally underperforming, but it's on my whiteboard to pay attention to, all right, to see if it ever sets up again on the whiteboard. All right. Let's keep moving. AVGO to round out my semiconductor list. It's just really hard to ignore that pattern. Perfect breakout of a pennant sitting right on top of the breakout. Right? Couple more names. I'm really curious about the energy stocks. They're making these double bottoms that are pretty obvious, right on top of support, right on top of the 200-day moving average. So I'm looking at the ETF now, XLE. We don't even have to go over which stocks in XLE. Could you own, CVX, Exxon? Sure, they're all basically the same. If I'm going to buy a big cap energy, I'd rather just buy the ETF, quite frankly, and get my allocation there. Maybe I have double a position size on to have a extra exposure, since I have no single stock risk there. I also like XOP, which are the U.S. production companies. Just clear double bottoms. All right, so eyes on energy. Is that inflation coming? Is there energy, inflation coming in traditional energy, even though I'm told that nobody needs energy anymore, right? Everyone's going wind and, uranium and solar and all this stuff. And yet these charts are undeniable. All right. And for those of you who are income investors, it forces me to look at the pipelines, my favorite group. No breakout there in Kinder Morgan yet. If it recaptures the 200-day moving average down here, recaptures the 50, maybe that's something I do. Okay. Williams tried to break out, right? But that looks great, Williams. These are like 7% yields on the pipelines. ENB and to round out One Oak. Those are my four favorite names. All right. So I'm going to round out with two more ideas. Disney. Just keep eyeballing this chart, and I'm thinking to myself, I got to own it. I got to own it. So if I get a risk monitor green signal, probably I'm adding shares of Disney. Okay. And I'm going to look at Netflix too. It's a huge pennant breakout here and a pullback. So it's on my list to own if it gives me an entry point and I have a risk on signal for the market. Look how well this stock is performing versus the NASDAQ 100 this last couple of weeks. Pretty good. That kind of goes right next to my CRM idea, right? Those names. Okay. So that rounds out the list for me of what's at the top of my whiteboard. And before I get to your questions, let's just talk about cannabis for a second. So looking at MSOS, I know this is near and dear to all of our hearts. Okay. So we talked about this last week, and I'm just going to talk about it every week now because we're in that territory where I'm looking for an excuse to own cannabis stocks. Okay. We originally owned them here. This was the excitement over Democrats taking over. This is the reality that Democrats can't get anything done, okay, or politicians in general, not to attack Democrats specifically. And so what we have here is a complete washout of all of that excitement, and now we're back to reality. So if nothing changes on the political front, will these companies keep coining money? And the answer is yes. So does a pattern develop that gets us to put capital to work? Okay. 2 up days. I know a lot of you were excited about 2 up days. It doesn't do anything for the chart pattern. Okay. Nothing. So a couple of thoughts to remember and think about. Number one, I don't think we're going to wake up on a Monday morning and some bill has been passed that changes this, the structure. Okay. It's not like a biotech company where, oops, there's an FDA approval you didn't know was coming and the stock's up 50%. So the way I'm playing this group is I really want to see a double bottom, a higher low, a higher high, something that changes the downtrend. Okay, so before we get our emotions involved in investing, we have to see price tell us that the trend is changing. We could do that with Fibonacci fan sequences. All right, there's nothing here. It hasn't even broken the first downtrend. So there's no trend change at all. Okay. So I thought today I was going to come on and talk about how excited I am, but in reality, there's no change. So I'm excited fundamentally about cannabis down here. It looks ridiculously cheap to me. There is this possibility We talked about this during the week, ARMR Insiders, but for those of you who are not subscribers, let me just, throw this out there real quick. We don't need federal legalization to make a ton of money in these stocks. What we need is a Safe Banking Act. We need liquidity in these stocks. We need institutions, both investors, banks, investment banks, the New York Stock Exchange. We need those institutions to be protected from federal lawsuits, to be protected from federal crackdown because they're involved in an illegal substance. Okay? So if we could just get a Safe Banking Act that says, look, if it's legal in your state, you can work with cannabis companies without the fear of the federal government coming after you. If that's ever passed, these stocks are going to go to the moon. It won't matter if we have federal legalization. Okay? So there's a possibility that between now and the end of the year, it looks as if the Safe Banking Act has been stuffed into another bill. I'm not going to go break down the whole story for you. You can find it on Twitter and the internet. It's been stuffed into another bill that it's as an amendment that should be passed before the end of the year. Now, that doesn't mean that the amendment can't be thrown out. I don't know. But if they're able to do that, we're going to want to own these stocks if they set up correctly. So my feeling is if that possibility is going to come to fruition, that the amendment is stuck to this bill and this bill gets passed before the end of the year, we're going to start to see higher lows and higher highs in price. And that will tell us, yeah, this is coming. Between now and then, you're going to have serious tax loss selling. Okay? So when this thing runs up into overhead, people are going to dump and take their loss. Right? And that's what makes the double bottom. You get a rally up off the low as relief. Then you get drilled back down because people are so happy they can dump their shares at 30, they're 35, but it runs up, right? But then the buyers come in more aggressively. And you know who those buyers will be? You and me. You and me. Let it pop, let it sell off. And if there's double bottom, higher low, then I start putting money to work. Okay, so that's where I am on cannabis. Let's get to your questions. I hope that was helpful. So anyway, as always, I'll get the questions right here. Let's take a look. I'm looking at the questions list. Feel free to throw things up there so we can discuss. First question from ID Doc. Okay. All right, Mo, you want to look at all these stocks? Let's rip through them. I'm going to take this. Let's just rip through them. All right. TSLA. So when we're looking at these stocks, I'm just going to share with you what would be an ARMR entry point. And so I'm not telling you what stocks to buy, right? It's got to make your own decisions. And it's not that the stock can't go up even if I don't like it. But I'm just going to share with you what an ARMR entry point would be. All right. Up here is not an ARMR entry point. This is just the middle of nowhere to me. All right. So the best entry point would be right in here as it holds the 50 and the 50-day moving average and then pops up. That would be the entry day. I got nothing to say about Tesla at that point. Quantum escape. That could be making a nice double bottom in here. I don't know anything about the fundamentals. It looks like it's a SPAC. I can't stand SPAC ideas. You have to really know when the next lockup agreement is. So, but that's a reasonable entry point. Although, look, the 200 days in a downtrend, the 50 days in a downtrend, the stocks below all of them. That's typically not a stock that I would ever buy at that juncture. Okay, I like to buy stocks that are in uptrends. So let's go over this again. We buy weakness in the midst of strength. That's the ARMR investing way. Where's the strength here? This is just massive weakness. All right, going on. Plug. Same thing. Nothing to say. Is there a possible double bottom? Yeah, absolutely. Could be. You could always put a position on using these lows as your stop. Nothing wrong with that. Okay. We avoided the collapse in gold stocks. Okay. We didn't own them in any of our portfolios. So I only share this with you because I was talking about how great this was looking. It was looking like a setup was coming. but it's trading below the 50-day, below the 200-day. The 250 are in downtrends. And so if you don't get that breakout, you can easily get smoked. So just because it looks like a double bottom's forming doesn't mean there's a double bottom until you get your trigger bar, right? Which takes you back above key levels. And as you can see on GDX, it could never get above key levels, right? So you look at plug, it could be building. It needs to get above key levels. For me, probably has to go above here, pop back above the 200-day moving average. So ideally, it blows out, pulls back, and you buy the pullback. That's how I run money, okay? I don't try to preempt or guess is the ideal way to do it, in my opinion, all right? Dual sell, same exact thing as plug, nothing else to say there. All right, there you go. So LCID is now broken out above all the moving averages. So now the bottom's in place, okay? And we're talking about investment entry points. I'm not talking about day trading. You could day trade anything. But so here's the nice breakout last week, and then you want to see a consolidation pattern. Maybe that goes to the top of the whiteboard if you like this company, because it looks like the shakeout and reversal is in. Oops. Lordstown, nothing to do with that. Weakness on top of weakness on top of weakness. DQ, I have no interest in buying Chinese companies. I never have, never will, and you can see why they've been getting destroyed. So I don't touch those names other than day trade them. Yeah, some of the maritime stocks look great. You know, I don't know anything about ship, and certainly that chart looks pretty awful, but who knows? Maybe it'll start to take off. There you go. There's a pattern that looks like it's put a double bottom in, but below the moving averages and closes above the 50 and the 200. So this would be, STEM is very compelling to me. There's a big double bottom here. There's a little double bottom here, and it closes above the 50 and the 200. So the low of this bar would be your stop, and STEM would go to the top of my, in fact, I'm going to write that down. STEM would go to the top of my list. If I had a fundamental reason to own it, that's where you'd want to own this thing. You'd really want to start to look at it, and you, of course, would use the low of Friday as your stop. That's the best looking setup to me. Oops. And SunPower, I mean, the SunPower companies just keep underperforming and going nowhere for me. So what is it? ENTH is my favorite. Let's take a look at that. The charts just don't do anything for me. And here's, oops. And here's TAN, right, which is the ETF of all of those names. So it's possible they're building a base there. I mean, if you believe in this group, that's the right place to go take a shot. And that's, you know, all of the solar companies. That's the ETF of all the solar companies. Quite frankly, if I was going to play solar, it would be the ETFs. I mean, but I can't stand Chinese companies. And so a lot of the, you know, the solar stocks are attached to China. And I think that's, you know, a danger that is impossible to hedge against. So I generally avoid these stocks. Anyway, those are my thoughts there. I hope it helps. Good morning, Erez. How are you, my friend? Hey, Deb, I really appreciate that. You know, sometimes it's tired. I'm tired on a Saturday and thinking maybe I'll skip it. But I love meeting with you guys, and it always helps me make money the following week if we have these conversations. So thanks for being here yourself. All right, Snap. Yeah, Snap's holding up great, and I guess Snap could be on that list with CRM and Netflix and Snap. I mean, it's holding up great, and you know, we've got to put that at the top of our list again. It's really holding up well, and I just like to put Twitter along with Snap. I always feel like at some point Twitter is going to break out of that reverse head and shoulders. And where do you buy it? Right here, close to the 200-day. I'd love to do that. If I had a risk monitor green, Twitter would be at the top of the list. Twitter, Snap, CRM. You know, these are some of the big cap tech names that interest me. So I'm glad you brought it up. Took profits on uranium stocks. Looking to buy again. Where would you enter them? Saber, good for you. You made a lot of money there. Makes a lot of sense to book profits when you have a rip like that and you put in a little bit of a top. CCJ is the leader. Okay, so when CCJ does that, you know, it's always best to book a little bit of profit, right? You had that high tight pen and it broke out of on Friday to the downside. So we identified the right entry point, the ARMR report. ARMR Insider Areas was on top of this, sharing this idea with the ARMR community. Right here as it broke out of the 50-day moving average. That was the entry point. Okay. So I know a lot of ARMR insiders have made a lot of money on these names on this rip higher. How do you trade it from here? It's a good question. I'm thinking about it. I mean, look, that's clear breakdowns from the top. Okay. So they got ahead of themselves and they're going to pull back. I think the best thing to do is to look for a consolidation at some point on a key moving average. And you don't see that right now. I also think that it's dangerous thinking to assume that uranium prices can only skyrocket. Even in massive uptrends on all kinds of commodities, you will have shakeout weeks where they just get crushed for no apparent reason. I mean, let's just put it this way. One of the primary drivers of the whole uranium move is the fact that Sprott has started a uranium trust and raised, have $1 billion, is it $1 billion worth or billion? Must be $1 billion worth of available shares so that they can take in capital and go buy more uranium. And I know that was the excitement and it drove the stock a lot. It drove the asset a lot higher. So it's an asset with limited supply that's kind of thin and a big player announcing an ETF, or not an ETF, but a trust to go in there and buy a bunch of yellow cake. So that got a lot of excitement and blew it out. But ask yourself this question. Do you think that Sprott would want to continue to drive the price dramatically higher before putting money to work? Like, they're not stupid. The price has skyrocketed. Do you really think they're going to raise a lot of cash and immediately go buy more and more and more? Or, as institutions tend to do, and I'm not saying Sprott's doing this. I don't know what Sprott's doing, but I know smart institutions. This is something you can write down and remember it. Not that it can, you never know when they're going to do this, but this is a fact. Okay. Big institutions who want to accumulate a lot of a thin asset, one of their favorite things to do is dump a small amount of the asset, but dump it aggressively to shake out shareholders, to shake out commodity holders, right? So they might have, here's an example. Institutions might have 10 million shares of a stock they want to own. And we know what they'll do. They'll go out there and aggressively sell 100,000 shares. I mean, hit the bid like crazy. They have 10 million shares they want to own. How about 1 million shares? They have 1 million shares they want to own. They take 100,000 of the shares they already own and hit the bid as hard as they can to get the thing to break. And then they step in and buy all that they want to buy. This happens all the time. Okay. And that's in regular stocks. So I'm just saying it wouldn't be surprising at all to see the price of uranium drop $5 or $10 so that then the fund could buy as much as it wants before the price jumps to $70 to $80. I mean, that's just logical. Just think about it logically. So I'm just saying, you look at the charts. This is my last thought on uranium. You look at the chart. This is the announcement that Sprott is starting to buy uranium, and it blew it out. Then this week is the announcement Sprott, is getting geared up to buy a whole bunch more, and the stocks are starting to break down. The stocks usually lead the commodity. That's typical in commodities. Stocks lead commodities. The miners usually lead the commodity. So if the miners break down, my guess is the commodity is going to take a break and sell off. Then the whole thing starts all over again. So my eye is on this. This is my favorite name in the space because it's the biggest, most liquid. So, I'm looking for a setup. So what you'd like to see is the stocks have come down. Then you see a couple days of the commodity selling off. Just a couple days, And while the commodity's selling off, the stocks stop going down and find support on the 14-day or the 25-day moving average, maybe the 50, who knows, right? And set up another base, and then we hop on them all over again. Now, look, I could be totally wrong, okay? There was talk on Friday that a lot of the selling in these stocks had to do with options expiration. It was quadruple witching. Maybe that's true. Okay. So if you're an aggressive uranium buyer and you believe these things are just going to go straight to the moon, and it can happen. I mean, I could be wrong, but my job is to get on the right side of probability. So there's maybe a 10% chance that it just goes straight to the moon and a 90% chance that it has structure along the way that we can buy. Okay. So I would say the high of this bar on CCJ is where you would put a position back on if you're desperate to own them and you don't want to miss an explosion higher, okay? This is the breakdown bar. Friday was the breakdown bar in the stocks. Either they come down and set up another base to buy, or they take out the high of the breakdown bar and you get right on them because they're going to explode again. That's how I would trade it if it were me. All right. Kirkland, good for you. I mean, look, there's ways to trade the mining stocks, and quite frankly, Kirkland has held up better than the rest of the group. That's incredible. What a chart pattern there. The rest of the group's breaking down. Oh God, Wheaton Precious just got wrecked. That was one of the last ones to hold up. It got destroyed. So who knows how long Kirkland will last. Kronos, we haven't talked about the Canadian names. They've unwound all of the gains. Look at that, all the way down to here. I don't know. There's just no reason to own these names right now. There's just nothing there. Nothing. Remember, we talked about it. I said, look, maybe it's going to hold this trend line, and then it broke below that. I mean, there's just no reason. We need higher lows and higher highs before we start buying these names. Otherwise, just move on. Hey, Ken, how are you, man? Nice to see you. Yeah, I think you mean APPS, right? Apps is on my list. Digital Turbine is starting to show up on my list to be interested in. It has, I love shakeouts below the 200-day and then immediately revert. Let's write this down on my list. I forgot to put that. Thanks a bunch, Saber. Right, it dropped down and immediately recovered. That has a little cup and handle there. That really looks compelling to me. I love the apps story. Boeing. Below the 50, below the 200, bores me to death. No interest in Boeing. IBM. What a head scratcher on IBM. Stocks now below. I mean, we sold it, all right? So we're out of it for now. But from a dividend collecting standpoint, as long as the stock stays in that uptrend, right? And, look, I mean, I think the dividend is safe. I think you can keep collecting it. And I think ultimately the stock goes up. But it's just a market stock right now. And it's a laggard at best. I mean, it's not the greatest market stock. So it lags the market, and the market's getting whacked, and it's in the Dow, and the Dow's going down. So IBM doesn't look too good here. But who knows? Maybe it'll hold that support level. All right, guys. I'm going to sign off for today unless you have any last-minute questions. I appreciate time spent as usual. And I wish you all the absolute best of luck next week. Don't shoot till you see the whites of their eyes. Focus more on protecting your capital first. There'll be time to capture upside. Okay? There are always periods of time where a particular approach is going to underperform. My job, as I see it with my personal capital, is for my underperformance to be flat, right? So what I'm trying to do is not give anything away so that I can stair step higher when the window opens for what I do. And that's what it's been like for the last 6 months for me, right? I'm just constantly protecting capital, putting capital back out, waiting for the window to open to step back to the next new high in net worth. Okay. And primarily what I want to do is avoid a massive give back of capital because the market's imploding. So risk monitor red, protecting capital now. If it changes next week, great. We put money to work. But don't get complacent. This is my last thought. Don't get complacent and just think, oh, the market's got to go up because it goes up every time it hits the 50. Options behavior always drives the market higher. That is a dangerous headspace to be in. Don't get complacent. Keep working. Have a great weekend. I'll see you guys at 8:30 Monday morning, All ARMR Insiders, for our Monday morning meeting to get us ready for the trading session. Take care, guys.